Good morning, everybody. Welcome back to Morning Markets on Tuesday, the 9th of June. A couple of things that the team and I have been discussing this morning that I wanted to share with you. The first of which was just our usual run around the various asset markets across the globe and what's been happening over the past 24 hours. What did we see yesterday? We saw a little bit of weakness in the UK and European equity indices. I think that comes in the back of the German industrial production number for April, which continued to show a decline relative to that of March. Now, that's probably not unexpected, but I suppose it just did bring back a little bit of realism to some of the strength that we've seen in European markets over the past couple of weeks. If we turn to the US, however, a very different story. The US equity markets, I should say, continued to build on the strength of the surprise from the unemployment report on Friday, and this saw the S&P increase over 1.2% for the day. What did this mean? It took the S&P up to positive territory for the year. Yes, indeed, up for the year. Something that I think we would have probably all thought only a number of weeks ago would have been a difficult statement to have been able to make, but there we have it. S&P up for 2020, and the Nasdaq continues to move higher, and each time it's moving higher at the moment it's reaching a new all-time high. So US equity markets continue to move ahead. I think that speaks to a couple of things that we've been discussing with our advisors and clients over the past number of months, and indeed over the very, very long term as well. And that's the importance of diversification, the importance of thinking about investment from a multi-asset perspective, and setting a long-term goal and focusing on that long-term goal and the achievement of that goal regardless of what's happening in the market, using the market as a means to consistently save to achieve that goal. If we then look at other asset markets over the past 24 hours, we saw a little bit of movement in yields in the US Treasury. Obviously they sold off on the back of the strength of the employment report on Friday, and they came in a little bit yesterday, so back below the 90 basis points level. In the UK, gilts are sitting at 33 basis points in the 10-year, and that's ahead of quite significant issuance from the Debt Management Office over the coming days. So we'll see how that comes and how that is digested by the gilt market over the coming days, and indeed what sort of yields are offered to bring investors into that market. Then the other thing that we just touched on this morning was two things. One, just the commentary that Christine Lagarde gave yesterday at the European Parliament. That was interesting from two aspects. One, the discussion around how the ECB stands ready to help with the German Constitutional Court judgment around the legality of the bond purchases that the ECB is doing. And then secondly, really continuing to push and to throw the gauntlet down to the European politicians with regard to the 750 billion support plan that's been discussed and will be discussed at the leaders' meeting towards the end of this month. So again, really emphasising it's up to you, politicians, to deliver upon this. And then finally, we had the British Retail Consortium data today. And yes, they continue to show weakness, as we'd expect. We're only now starting to get to the stage of discussing shops reopening, etc. I think for me, the big thing within it is that 60% of sales were conducted online. Now that's obvious for the reasons that we all know, but it's one of these things that I wonder, does it create more of a secular push and a gradual move to more people transacting online? And does that have ramifications for markets? Does it have ramifications for how we transact more fundamentally? So that's something that I think is really interesting and continues to monitor, and we'll continue to discuss with our investment partners over the coming months and years ahead. The final point that I wanted to share with you this morning was regarding the Main Street lending program that the Federal Reserve has in the US. And this is a program of some $600 billion that was set up to support Main Street effectively and through the business lending programs that it has. The terms of this program for many were considered maybe too onerous when it was initially put in place a number of weeks ago. What has the Fed done? The Fed has made quite significant changes to the lending program over the past 24 hours, including the minimum size, so reducing the minimum size of the loan available. also thinking about the term and the rate that is on offer. So quite material changes to the programme with the aim of supporting small and medium-sized enterprises in the US. That's crucial at this point given the importance that they have both to economic growth, but probably more fundamentally the number of people that are employed in small and medium-sized enterprises throughout the US. So that's a real positive to see the Fed taking on board the criticism of that programme and making it more accessible. Many thanks for your time, and I look forward to speaking to you tomorrow. The other thing that I just highlight is the chart of the week from my colleague Chris Leyland. Please also look out for that. Thank you again.